I'm here with Joe Salvatore. Is it Salvatore or Salvatore?
Salvatore.
Salvatore.
Yeah.
Well, anyway, it's a pleasure to be here with you, Joe. Joe's a customer of ours and someone we've been working together. You are the Chief of Risk and Underwriting for Idea Financial. Is that correct?
Yes. Yeah. Thanks for having me on.
Yeah, of course. Do you want to give us a quick introduction of your background? Go ahead.
Sure. Yeah. Joe Salvatore. I'm the Chief Risk Officer at Idea Financial. We are a small business lender. We've been in the space now for about 6 years. We lend money to small and medium-sized businesses. We have a flagship line of credit and a term loan, and also a specialty finance product for plaintiff law firms where they can borrow capital to use towards particular contingency fee case expenses. So a few different products. And yeah, I'll give you some quick background. I have a background in statistics and also psychology. Went to the University of Tennessee, go Volunteers. I was there for, around 5 years or so, where I worked on 2 master's degrees and a PhD. Was really planning on staying in academics. Thought to myself towards the end of my tenure there, might as well kind of just go see what industry's like. And I really ended up loving it, to be honest. So I've been, in the industry now for about a decade now. One thing that I really liked about industry relative to academics is that, a lot of the work that I used to do in the research lab is highly kind of theoretical. I was able to kind of apply the same sort of, approaches, methodologies, use the same skill sets in industry and be able to really see, if my ideas were, held water, if they were right. And it was cool to be able to come up with an idea, design an approach and methodology, come up with hypotheses, test those hypotheses, and then put that sort of approach into production and then watch the data come in. And that was something that I really kind of fell in love with. And I've been in industry, 10 years now.
That's awesome. And so we work with, this is an industry we love to work with, is people in this alternative business finance industry, probably some of our favorite customers now, but I work with a lot of risk officers similar to you.
Yeah.
They're the main people that are working in this data, and no one has the kind of background that you do where, it's in statistics, it's in analysis. You've been doing credit for this long. So you have like a wealth of knowledge and you're tying into it experience, like you said, this last 10 years. So you're kind of a unique beast. Do you find that to be the case when you look at other people in the industry?
The industry has, a ton of variability in terms of, those that are successful. Oftentimes, I think some of the most interesting approaches come from folks with varied backgrounds. So they may not be in business, but that's certainly not a bad thing. Mm-hmm. When I think about, like, for example, not one on my data science team has a background in business. They've all come from pure mathematics, computer science. I think the closest would be double major in economics or something, but along with something, in the sciences. And I really do value that approach to problem solving, because at the end of the day, if you're a researcher, you really care about how the world works. We're all trying to figure out, the truth. So taking that approach to commercial lending, for example, working with smart folks, you're going to find what the truth is, particularly when there's different approaches and different ideas about how the world works. We're all working together, and at the end, we're all just trying to kind of figure out how things work.
Yeah. And some people have data scientists, but I don't think they have a team. I don't think they have people like you in this industry. I think they have experience in the industry, and that's mostly how they're approaching their underwriting.
Yeah. And, that is an approach. Like I said, we sort of try to value potential, the sort of tenacity to learn and understand. And it's sometimes better to not have that experience because you don't have to break those bad habits.
Yeah, that's really cool. It's great to work with you. But this industry, I say it's new, kind of new. It is kind of, it's been probably 20 years.
Yeah.
Right?
Even a little less, right? Like,
maybe even a little less before. It definitely is
2008, 2010, 2008 crisis. Mm-hmm. I think a lot of alternative financing kind of was bred out of that period.
Now, there's already been a ton of changes since then, since in the last 10, 15 years. What do you think is going to change from now in the next 5, 10 years? So how do you think the industry will change?
I wish I had that crystal ball, because we'd be ahead of the curve there. Yeah, there's a lot of permission-based data that is becoming much more accessible and kind of agreeable to the end user or the applicant, the consumer, or the commercial entity. So that seems to be something that's very popular. I'll liken it, when I first began in industry lending, cash flow based lending wasn't as popular. And, it was still kind of heavily credit influenced, which the credit data is very important, right? But the cash flow information offers another degree of understanding of, the financial health of the entity that you're underwriting. That has grown tremendously to where it's, I estimate it to be 60% of the ultimate kind of predictive validity of the risk models that we're building.
So you're saying cash flow. You feel like cash flow is 60% of the, sure.
Yeah, at least for a product, a shorter term product, when you're talking, anywhere from 12 to 36 months, the cash flow is very, very important. Credit will begin to become more important over longer periods of time, but in the short term, when you're trying to predict out a year, the cash flow data is extremely important. That said, 40 or 50% credit data is still very important, but that permission-based data, that will start being more of a contributing factor and, ultimately help the models get more and more accurate.
Yeah. So if you were talking to a merchant, I don't know how often you are on sales calls or deal with the merchants directly, probably not a ton, but if a merchant was coming and they were shopping, why do you think they should pick IDEA versus another option?
Yeah, sure. So I guess we'll talk about it in kind of two separate arenas and areas of value. One is going to be when you look at an option like IDEA versus other alternative financiers, it's very simple. This is product. We have a true revolving line of credit. So you borrow what you need, you pay for what you need, and you can pay back at any time with no prepayment penalty. Much of the alternative financing space leverages simple kind of plain vanilla term loans. Those term loans have a particular factor rate associated with them. So if you borrow $100,000, you're going to pay $20,000, let's say, in interest costs. So that's regardless of if you need to borrow that money for 6 months or 18 months. With our product, you're able to just borrow what you need. There's no, additional fees. And then when you're talking about comparing this to traditional financing, of course, it would be speed and ease. Come to our website and put in your information, either link your banks or attach some bank statements. And then within the day, you'll get approved and you can draw that day. And funds will be in your account the next day. So very different, of course, when you look at it relative to the traditional market.
Sure. You can get that money a lot quicker where they have revolving line of credits, like you said, but that's not a very common thing. And if you need that money a lot quicker.
Right. Yeah.
Right.
Exactly.
And probably, like you said, you're going to assess revenue more than, if their credits may be a little bit worse, you're probably going to be a little more lenient on that based on revenue.
Yeah. Yeah. And this industry was born out of, let's say more poor credit conditions, right? Credit's still important to us relative to a lot of our competitors. We have, much lower costs and a true annual interest rate that's comparable to your credit card rates. So, this isn't, 40, 50, 60% annual interest rate. This is in the 20s. And to be frank, our specialty finance product for lawyers is in the teens. And this is in a period where all you hear is interest rate hikes and increases. So we're still able to stay, very competitive. We're not a bank and we're not the SBA, but looking at the alternative financing space, it's very attractive rates. So a lot of folks come to us because of that.
That's awesome. And that's interesting when you brought that product up. I didn't know you had that product that's focusing on legal teams. I'm kind of curious, what's the story there? Why? How did you get into this?
Yeah. So let's say 60% of our executive team have a background in that space, either trial lawyers or had gone to law school. So it's kind of specialized knowledge in the legal space, lending companies. So we combined both of those. And our CEO and president also were involved and created a insurance product for plaintiff lawyers. So imagine this, you're a plaintiff lawyer, you take on a case for a contingency fee. You may end up spending $50,000 on that case for expenses like expert witnesses, travel, any other expenses that are associated with building your case. And then you go to trial. And if you lose, you not get paid because your contingency fee, but you're also out that $50,000. So a insurance product was created that protects a plaintiff lawyer and law firm against the most catastrophic loss at trial. In that case, for a premium, you get your entire case expenses reimbursed to you. So that product in the financial space, lawyers had really gravitated towards that product. It seemed like a kind of natural progression to also provide the financing, not just for that product, but for the case expenses.
Yeah, that $50,000, they had to find that money somewhere, right? They either have a big bank account or something to have that cash flow. That's a really good idea.
Historically, plaintiff lawyers had put out their own cash for expenses on contingency fee cases. Now they can borrow that cash and use that as well to purchase insurance. So in case they do go to trial, which most cases do not, but the ones that do, you're basically at a coin flip, whether you'll win or you lose. We've done a ton of actuarial work on cases and case outcomes, and about 50% of those that go to trial win and the other 50% lose.
That's some interesting metrics you probably have there. I bet how does the lawyer feel about that? You're like, okay, I don't think you're very likely to win, so we're going to increase that premium.
Right.
On that.
Yeah, it's basically a coin flip. Now, when you combine that with the likelihood of going to trial, it's very low that you go to trial and lose. But if you get to trial, again, it's basically a coin flip. So it's nice to have that insurance.
Yeah, of course. Now, do you change your rates based on if they have that insurance or not? What if they don't have the insurance?
Yeah. So there's some factors that go into whether you qualify for the insurance. So today, the rates aren't any different. Really, what we're doing on that product is that we're using our commercial underwriting. That's tried and true. We've designed and developed it over the last 6 years. So we're underwriting the entity for creditworthiness first and foremost. We are really assuming you don't have the insurance. If you do have the insurance, then that's great for you, because if you do go to trial and you lose, then the insurance actually will pay off the money that you borrowed. If you don't, that's okay. The product also has a period of time where you pay principal and interest. You can pay that off over time.
Gotcha. I see. So either way, you're planning they don't have insurance.
Yes. Yeah, that's the assumption, right? But of course, it's a great cross-sell opportunity.
Yeah, certainly. Now, but you don't offer it? It's like a separate company?
No, it's all under the same umbrella.
It's all in-house. Okay.
All in-house. Exactly.
So would you say Idea Financials, are lawyers like you love working with those? Are those your favorite?
Love it. I do. I can speak for myself. I think everybody that I work with really enjoys working within this product. Yeah, it's a great group, a great, kind of niche market, and really bright folks. And I'm constantly learning. So it might be a little kind of selfish, but I like working in that area because I hadn't had any substantive experience, and it's very interesting. You're sort of getting a law school education while you're getting paid. So it's great.
Yeah, that's fascinating. That really is interesting. You have that product. That's a cool. Yeah, that's a good idea. It's one of those things you don't know about unless you're in the industry, like you said. A lot of your
exactly. There's kind of speaking to that. There's a lot of education that goes into this product. Even lawyers aren't aware that there's a product like this. Everyone's aware that there's financing. However, historically, it had been just kind of large umbrella line of credit that your firm would draw from. However, there's some disadvantages to doing that. Now, many states have rules on this, but you're able to pass through interest costs to your client following, a successful either settlement or win of that case as a, basic case cost. However, you must be able to itemize that interest. And if you're drawing from a line of credit and you have, let's just say, 5 or 10 cases, it's very difficult to be able to do that. So historically, plaintiff law firms had just eaten that cost. What we do is we offer you a master limit. And from that master limit, you can create as many cases as you have. And then you draw on those particular cases. And we keep track of all of those interest costs.
So super easy for them to track.
Very easy.
Oh, yeah.
Yeah. So that's been a big selling point, essentially being able to pass through those interest costs, which go to help and save margin.
Yeah, that's fascinating. I appreciate all this. This has been a lot of awesome information. And now we started talking together with your integration. I just want to ask a little bit more about how the integration was with Cobalt and what made you make that decision.
Admittedly, I'll say I didn't do the integration. We have a ton of folks on the team, much more talented than myself, and they were the ones that did that integration. But I can tell you that it was one of the faster integrations. I think it was very straightforward. I know that the format and protocol is up to date and simple relative to, let's say, some of the more traditional bureaus that we've done integrations with. In terms of from an adoption standpoint, it's been amazing. We process between 5,000 and 10,000 applications each month, and this was an area of the business that was completely manual still. Much of our process has gone to a more automated approach, but this was an area that was sort of the Achilles heel where we didn't think that we'd be able to automate this side of it. But yeah, your product has proven to be a great solution to that.
Oh, that's awesome. I'm really glad to hear that. Joe, I appreciate your time. Love partnering with you, and hope to be able to continue working with you a lot in the future.
Likewise.
If we ever need to talk baseball stats, that's when we can. I know the guy to call now.
Very good.
For my son's 11-year-old team, I was like, okay, this is his OPS. Where should I put him in the lineup,
Get him started young. Yeah, good.
Yeah. All right. Anyway, Joe, it was a pleasure.
Thanks, Jordan.